Good morning and welcome back to the Opportunistic Trader for August 30th, a Thursday. Looks like a pretty exciting day across the board and across the world. I just want to
Relative to yesterday.
Yes, and I just want to talk about yesterday's action briefly and some trades that we did and where our positions sit at this moment in time. So yesterday was very, very quiet. We shorted S&Ps at 29. It's scary when I say the number 29.08. Put a stop in at 18. It's trading at 09. So we're sort of back in the game. Not really losing there very much. Gonna probably not be able to take a lot of profit if we get there on this. So I don't know what the scalp will be. But all we have on right now is that position. We traded Crude in and out a couple of times yesterday for small profits, which we were happy with. And overall, it was a quiet day, and equities kept doing the same thing that they do pretty much every day, which is melt up.
Stop us.
And that was sort of the action yesterday. There hasn't been a lot of movement in bonds, and haven't really touched on those at all. And, looking at the board today, starting in Asia, those markets were slightly lower. China down a little under 1%. The big story today, which we're going to hear from Greg in our FX room throughout the day, and later he'll come on the site audio, is the big movements back in the dollar and against the EM currencies. Turkey's almost back to $7. I saw the Indian rupiah is at an all-time low. South American currencies are just getting crushed. So that's really the driver today. Looking at Europe, interesting trade today. When I woke up at about 5 in the morning, the DAX was down a smooth 170, almost near the monthly lows. Not really doing very well, down about 5% on the year. And then I got up, got in the shower, got ready, and it was only down 50 points. So it rallied
their
up.
inflation rate just came out, Larry, just to throw that in there.
Yeah. So
that might be part of it.
Yeah.
Whatever.
So
a reason to buy.
Right. So maybe that was the reason it went down. But overall, those markets look heavy. Markets around the world look heavy. The only market that doesn't look heavy is the S&P or the U.S. equity markets, and more so the NASDAQ. And watching these stocks, Amazon's about to hit a $1 trillion valuation, which I guess is chopped liver, doesn't mean anything anymore. And it's funny, like the value of like the fourth or fifth largest markets, like $4 trillion. So you have like two stocks in the U.S. worth more than most markets in the world. So
exactly.
We have that going on. And overall, looking at today is not an expiration, but looking at the pricing, they're not pricing in all that much. What's interesting, I think, is it's either today or tomorrow that they suspend the buybacks for these corporations, which I think is an extreme part of this move. So, we'll watch to see if that has any impact. But overall, with markets around the world getting crushed and uncertainty all over, and, the market, the S&P holds up ridiculously well. It's up about 1.5% for the week, or somewhere around 40 handles. And, the weird part, and I think you want to touch on this, is the VIX. The VIX is trading at 12.5. It was 12.5 when the S&P was 30 handles lower, and it's back to 12.5. And the back month volatility, the volatility futures, are bid at the 14, 15 levels. So, I think they're expecting some major uncertainty here. It should be, interesting to see how it plays out. But for now, they're ignoring, I don't know if you'd call it fundamentals, but just fundamental action across the board. And market.
There seems to be no concern of event risk in the stock market. Meanwhile, everyone else is looking at event risk as a big factor, especially the emerging market currencies.
Yeah,
That's the trick. That's the thing.
But what I've pointed out multiple times here, which I want our community to understand, is market action dictates what it is. So in a strange way, the only way really to propel higher is if you have negative news that they just shrug off in 2 days. I remember about a week and a half, actually mid-month, August 14th, we were quoted in CNBC on their Business Wire. They called us asking about Turkey and the effect on the market, and Turkey's basically on the lows of the move on the currency and the dollar on the high, and nobody seems to care. The Italian bond yields, nobody seems to care. So again, I think they're all reasons for the market to propel higher, sucking in more shorts. But listen, my opinion, which is longer term, is this is not going to end well, but you just don't know where it's going to end. And I'm not recommending anyone get in front of it. There are good trading opportunities to the short side potentially here, and we will take them when they come up. So
right, macro opinions don't really affect micro intraday trades. I mean, it's just
no. We want to be nimble here. We want to look for opportunities to make money on a short-term basis, and I think we're pretty good at that. And both in equities and indices, we're able to do that. Looking at it's funny looking at like FANG yesterday. It was interesting. Apple did its alley-oop like it's done every day, and it's an amazing thing that it adds $20-30 billion like it's water. Meanwhile, that's more than the value of Twitter and a number of other stocks. It's half the value of Tesla, and it added it in 2 weeks. So that's interesting in itself. But it's funny, like the FAANG just seems so weird. Like they buy Amazon one day, they sell Google the same day, and they sell Netflix and buy Apple and sell Facebook.
It's like so they're rotating within the people are rotating within the sector now.
Yeah, I mean that's.
Did I say sect? It sounds like I'm talking about a religion. But anyway.
But they they rotate in and out of these stocks, and it's very interesting. But I think you can't really get a takeaway from the market, especially like today or this week. But coming back after Labor Day, I think we'll see some interesting action. I think the big trades, which is really not my forte, and Greg is really good at parsing out the news and really being on top of this. And I'm pretty happy and amazed at how good he really is. And he's all over this stuff, and he's texting and we're talking, and the bottom line is he's in the chat, and this stuff is going on all day and all night. So there's opportunities out there, and the bigger opportunities now, I guess, is in emerging market currencies. The movements there are pretty amazing. So I feel like maybe taking my money and moving to Turkey. No, I'm only kidding.
Right,
you could live like a king there, but who would want to do that? But it's funny when you think about it. The only time it really affects you is when you're in the country that you're talking about. So
right,
that's
you'd live in Turkey and trade your money offshore, probably.
Yeah, exactly. But that's
you
what
want to
I
get
see. Any thoughts from you today?
Yeah, I mean, not much to say about gold. I'm going to give you two numbers in gold, then I'm going to move on to something else. But I think we should, before I even move on to the quick thing I want to talk about on the VIX, is the numbers today. Even though we are disbelievers in the fundamentals behind headlines, they do move the markets. So at 8:30, we have jobless claims, right? I think they're expected at 212,000. I'm not sure. I just trade when the number comes out. And we have PCE, personal income and spending for July coming at 8:30 as well. I think they're both supposed to be in the 0.4% range. Canada's got second quarter GDP. Normally, I would not give that much thought, but with the whole NAFTA thing going on, that might be something to pay attention to as well. So we might have some knee-jerk reactions. And today is the Thursday before Labor Day. So, Friday follies, get me out before the weekend, may happen today. So you may have your big short-term blip moves in the market as the day comes to a close today. Gold, I'll give you two numbers, and then we can talk about what you want to talk about, unless you want to go back to the VIX. I'm going to be looking to fade rallies between 12.12 and 12.14 as a corollary to gold hates the teens. I'm not going to be shorting at 12.15, 12.16, although that may be the move to do. Below 12.01, below 11.98, it's probably a sale down to 11.80. So above 11.98, you could buy it. But that's pretty much all there is to talk about in gold and its brethren. You want to talk about the VIX?
Well, before I touch on the VIX, or we touch on the VIX, the one market that we sort of left out, which is actually come all the way back, is oil. Oil is trading at $70 a barrel. It spent 75% of the month below this level. So they're coming up near the highs of the month, and it's an interesting thought that S&P weakness, and that this market is S&P weakness today, and this market is trading higher to the highs of where we are. So it's a market that I want to keep an eye on. I want to sell oil up at 70.10, 70.15. I could get it a little aggressive if it doesn't hit that level in the next 15 or 20 minutes. But overall, I really like trading that market. It's a really good trading market. It's a good swing trading market, and until it's not. So it's been that way.
No, but it has been forever. I mean, since 93. It's liquid, it's deep, and it moves. I mean, can you ask for more?
Nah. So it's it's a good market, and we like to trade it. So I just wanted to point out it's 70 a barrel and looks bid. So we're going to look to short it a little bit higher, and that's that for that. As far as volatility, it's very interesting to me. The market's taken out the old high by a percent and a half, and volatility is 30% higher than it was the last time we were taking out those levels. So I don't know if people are just getting protection on for the next up wave, or what it actually is, but it's it's very bid for now. So I'm expecting the market probably not to hold in here, and have the ability to trade it.
If I can add to that, Larry, in a more macro sense, we talk about the VIX being up 10% or down 10%, and we understand what we're saying, but we want people, subscribers and the community, to understand that when you say when we say that the VIX is up 1%, we're not saying that volatility is up 1%. We're saying that the volatility of volatility has moved 1%. So if I were to say VIX is up 2% today, that's like saying the VIX is going from 12.2 to 12.4 or whatever. The point is, the VIX, I'm not saying the VIX should have low volatility. I'm not saying volatility should be low. The VIX's volatility itself should be low. But when you look at, the VIX should be a lot of range-bound stuff with occasional 20% moves. To give it some perspective, if the VIX or equity volatility is 12.4%, a 20% move in the VIX is nothing. That's like you and I talking options saying, hey, what did vol do today? It's out a tad, 12.4 to 12.6%, that type of stuff. But to give it some perspective, that's an increase of only, you could see increases of 2.4% in implied volatility. And, you would say to me, hey, how did SPOO vol do today? It was up 2.4%. That's a move from 12.4 to 14.8. That's the more relevant measure. When you measure the vol of vol or the VIX or the VIX's moves, you're when I say you, I mean when anyone does this, you're not measuring volatility. You're measuring. Give a perspective. A 100% move in the VIX is going from 12.4 to 24.8. That's nothing. For example, ridiculous moves.
That's
Gold
nothing.
in 1999.
If that happened, the world would be it would be February all over again.
But you know what? And that's funny because that's exactly to my point. Look at the VIX monthly chart. You will see amazing spikes and long wicks on candles. That's because the volatility of volatility is low, and it's given to big moves. So it's kind of like,
well, the way I see it,
flat lines. And all I'm just saying, I'll finish up, and then you can just shoot me down on this. The reason, look, if gold vol, look, in 1999, I'm not going to focus on gold, but gold vol went from 5% to 100% in 1999. Look at the price of the underlying then. It's like $300, okay? Natural gas in a hurricane can move 5% easily, and it's already, in the 15 to 20% range, depending on when you're looking at it. I'm just saying that when you trade the VIX, you're trading the volatility of volatility. You're trading anyone who says, oh, the VIX, I took the VIX was up 0.2 today. I scalped that. Well, that's great. I think you're picking up pennies in front of a steamroller. Well, look at the wicks. Look at the wicks on the monthly charts. Volatility is different than the VIX. That's what I'm saying. Than trading the VIX.
The VIX, I get what you're saying, but the VIX is actually, the VIX is made up of the straddles in the market, so it's actually the option pricing. So,
no, I'm not saying that's. I understand that, but I'm getting into a concept maybe better put aside for advanced education. Not that you need it. I'm talking about kurtosis. I'm talking about when you trade volatility on an asset, you're trading volatility, straddles, let's say. But when you start trading the volatility, or let's say you start trading options on the VIX, you're trading the volatility of volatility, which options guys would call kurtosis. You're trading the tails, fat tails, thin tails. That's what you're doing. Even though you're trading straddles, you're trading the vol of vol. You're trading like the third derivative off of it. And that's where you get less and less and less volatility and more and more gaps in volatility. That's what I'm getting at. Listing the future,
well, I think if you're looking
decreases the volatility and increases the risk.
If you're looking at, I don't know what you're looking at as far as markets, but if we're talking about the VIX, the VIX as a product,
right?
What generally happens in the product is that volatility, they want to sell it. People want to sell it, okay?
Right.
Because they don't believe, they're betting or taking positions against the move. So,
right.
So what ends up happening, if we had down 2% days in a row, volatility would go from 12 to 25 in a heartbeat. And the reason, but the reason why that is because people are under hedged, okay, and over long always. Okay?
Oh, no argument. The market is dominated by producers. You're right.
But I'm saying, and it's worked, especially, I'm talking equities. It's worked on the equity.
No, when I say producers, I mean natural longs of stock. That's what I mean. I don't mean growing. They're growing stock is what I mean. Go ahead. I'm sorry.
No. So what I'm trying to say is the market, ever since algorithmic trading has come along, has been contained. Okay, we used to have 2-3% moves every single day. The bottom line is the computers, which run the entire market, will not let that happen because they control it. And when you look at my board that I look at, and I have screens all around me, everything is minimum tick bid with volume and quantity on it. So it changes, the dynamic. And what happens is when we get outside the band of, let's say, now, believe it or not, a 1% move in SPOOs is 30 handles. It's nothing. Okay.
Right.
Right. We get a couple of those days in a row and people are going to be blown out of business. So, we're in dangerous territory.
I think we're saying the same thing from different disciplines. you're saying, correct me if I'm wrong, you're saying that algorithms keep a lid on volatility with what I would actually call fake liquidity, meaning they'll be there for the 1% standard deviation and then they won't for the 3%. Meaning, well, we had the flash crash, that type of thing. Okay, so that's absolutely that's absolute's a bad word to use, but that's empirically very true. I'm not contradicting you. I'm just saying that when you list an asset, when you list a product as an asset, when you take volatility, which we traded as options, and put it as its own asset class, and you attract these natural sellers, which is what you said, and I agree with you, or people that will not hedge their stocks by buying options, they'll just wait for the VIX itself to move. What you do is you encourage algorithms to come in and give that liquidity that leans on real buying orders. So you have a buy order above it, a buy order above it, and then you've got a buyer above that. Well, the top three are algorithms. The bottom one is the real origin order. And what ends up happening is you have the illusion of low volatility. Well, you have low volatility, but you have the illusion of low volatility of volatility. So we're not going to have 2% moves a day in the S&P in volatility. But we are going to have, on average, we are going to have 10% moves in the S&P. I'm not disagreeing with you. I'm just saying that from a purely quantitative perspective, trading the VIX moves is trading the volatility of volatility. And playing that game is basically opening yourself up to gaps in volatility. That's what I'm saying. And I'm agreeing with you. When the bids go away or the offers go away, you have these massive moves after nothing for 2 months.
Right, but the only way you're going to see gappy moves is if the market sells off in any
agreed. And that from speaking, as a semi-quant, from that perspective, that's a comment on skewness, which is why I say producers dominate the market, meaning growers of stock. People issue stock, it's bought by funds, and they're more likely to hedge than people who are there's no natural shorts of stock out there. You follow me? It's like, a company issue stock, they're growing stock. It's kind of like producing oil.
Yeah,
if you're an oil producer, you buy puts.
But it actually goes the other way, because what happens is most of these companies, and it's been the last 5 to 7 years, it's the opposite. They're not issuing more stock, and they're buying back the stock. I mean,
okay.
50% of Apple's move.
You're right. You're right. I'm not
that they're buying back stock every single day in corporate buybacks.
Right.
You're seeing it on every name. So again, fundamentals rule the day. But when you're in a low liquidity environment, it's the opposite. The big talk, and it's been talked about for years and years and years, is that there is no stock. That they're creating their own potential short squeeze by buying back their own stock. So that being said, a lot of these moves are because of company buybacks. I mean,
I'll correct myself by saying yes, the producers are actually net buyers these days, and that's been the thing underpinning their stock. What I should say is the funds are the natural longs now, and the funds hedge. Or not the funds, anybody, investment portfolios, funds, mutual funds, ETFs, they put collars on. They buy puts and they sell calls. And that's just a reflection of the domination in the options market. Hedgers dominate the options market. Who are the dominant hedgers? The natural longs, meaning the funds. The natural longs, they were grown by the stock is grown by companies, but at this point, you're right. They're not growing anymore. So funds are the natural longs, and they buy puts and sell calls. And they're not even doing that anymore. So that's consistent with what you're saying about companies being net buyers of stock when you think about it.
Yeah. Anyway, so let's just, because we got the number coming out in a couple of minutes, we touched on volatility, just in general, the takeaway after we chat. I get what you're saying. But, I just want to point out to the members that, volatility is bid. That's just really the focus here. It's 12.5 on the VIX, and the back month futures, the SEP futures are 14 and change. So, I'm expecting, and that's basically 15 to 20% higher. So I'm expecting, a fairly large move in volatility.
That's a steep contango in the term structure of the VIX. I agree. Front month isn't really what you should be looking at when you're looking at measures of people's concern. You're right.
And so we'll keep an eye on that, but just the high VIX is a little bit concerning. And I just wanted to quickly go over the schedule. Today we have with us our equity guy, Tony Greer. He's very versed in the stocks, and he will go over his thoughts and what he's looking at. And then we have Gary Holland from Australia. He's our technical guy, looking at technicals in various markets. And then we're going to have our FX guy, Greg, on later to talk about what's going on in the currency markets, especially EM currencies. And the number's coming in about a minute, so I want to get off and watch the number and trade the number. And we'll be back to you before the opening. Thanks again, Vince, for joining us.
Thank you, Larry.
All right, talk to you in a bit.
See you.